Good evening and welcome back everyone to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today we're here to talk about the benefits of options trading. This is the first part of a multi-course series on the beginner options series to help beginners get a better understanding of how to utilize options for your portfolio. Now, the first few sessions are going to be more on the conceptual perspective and theoretical perspective to help you get a better understanding of options as a whole, because we tend to find that as you learn how to trade options, there is so much to learn. There's a lot of complexity, there's a lot of terminology, and many times you feel like you're drinking from a fire hose. There's just so much information coming at you that it's difficult to digest all of it, and sometimes you feel overwhelmed. So that's why I like to start the beginning of options education without really talking about strategies, without really getting into any of the details of option contracts. I just like to take a step back and help investors better understand, if you did go through all the education of learning how to trade options, what do you get at the end of it? So this helps motivate and helps you understand why you should take the time to learn options. And perhaps you finish a webinar like this and you say to yourself, I'm not really interested in that, because even if I do take all the lessons and I learn everything, I find myself that the benefits of options don't really apply to me. Maybe your portfolio is of a certain size, or maybe your portfolio is of a different makeup and you're not going to be able to utilize options. I'd rather you know that now rather than take the time to learn and then find out. So today's course is really designed to help those of you that are on the beginner side better understand what benefits options provides for your portfolio, and then give you a very, very basic understanding of option contracts so that we can move on to the next session and give you more of a foundation of how to trade options. So with that, let's go ahead and get started. But before I do, what we're going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any specific securities. So for those of you that are brand new to options trading, you can sign up for a free tool that is a partnership between OptionsPlay and NASDAQ Nordic that gives you access to the tools, the education, and the weekly reports that you might need to implement option strategies in your portfolio completely free of charge. All you have to do is sign up for a free account at optionsplay.se. So if you're brand new to OptionsPlay, I highly recommend that you consider registering for this free tool. It gives you access to a wealth of information and education that's already available to you, so that you can access those at your own pace, have access to the tools so that you can implement and analyze these strategies and hopefully execute those strategies at your brokerage firm. Now, before I get started, how many of you here are brand new to options trading? Please type 1 into the chat window if you're brand new or if you're learning how to trade options, and please type 2 if you have some experience trading options or if you're already trading options here today. So 1 if you're a beginner or learning, number 2 if you have some experience and you've already traded before. Okay, so I see a fairly mixed number of users of 1s and 2s. It seems to skew a little bit more towards people who have some experience options trading, but I still have quite a few beginners here. So let's go ahead and get started. Number 1, what I want to go over is talk a little bit about why should you trade options. So really jumping forward, instead of going through all the education first, let's jump all the way through the end. Let's say you finish all your options education. What do you get at the end of it? We're going to talk about 3 strategies: income generation. So if you have a portfolio and you want to generate income, if you're speculating, meaning you have a bullish or bearish view on a stock or an index, how do you take advantage of that utilizing options? And lastly, how do you hedge a market correction? Think about the sell-off that we had in February and March. Could you have possibly protected your portfolio from that sell-off if you were trading options or if you were an options trader? So we want to talk about how each of these 3 strategies, or these 3 use cases of options, how they are applicable, so that you can get a better understanding as to whether or not options trading or options education is worthwhile for you, because it is something that takes quite a few weeks, if not a few months, for most beginners to get to the point where they're comfortable enough to trade options. And at the very end, we'll talk a little bit about the basics of call and put contracts. This is really designed to give you a fundamental understanding of the contracts that are at the core of all option strategies so that you can take that education and move on to the next course and start learning more about trading options. You have to first understand the contracts before you can really trade them. At the very end, we'll open this up for Q&A so that you can ask any questions. But the primary question that I want to help investors answer here today is, what are the ways that options can be utilized in your portfolio? So my name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And today what I'm going to do is share with you, based on my experience of being a market strategist for the last 15 years, what are the challenges that investors typically have when they start the learning process with trading options, and help you overcome some of those roadblocks or some of those challenges when it comes to learning how to trade options. And this is not just a one-time webinar. We're doing a whole course here, multiple courses. This is the first one of a beginner's course. We're going to be back in 2 weeks to give you the next step in the beginner's course. And we always round off these courses with a live trading session where we basically analyze the markets together. We take what we've learned from the previous 2 sessions, and all we do is take the real markets and help you apply what we've learned to the real markets. Because every education here with trading, it can't just be theoretical. If you really want to be effective at taking the education and applying to your portfolio, we're here to try to show that to you. And that's part of why we have not only the education, but also OptionsPlay available to you free of charge so that you can have the education and the tools to apply to your own portfolio. So let's go ahead and get started here. Now, first of all, what we want to try to answer is the question is, why should you trade options? So we trade options because we are all, as in one way, shape, or form, participants in the market. How many of you currently trade stocks in your portfolio? Stocks or ETFs in your portfolio? Please type 3 into the chat window if you currently trade stocks or ETFs in your portfolio. Okay, so I see a lot of 3s. So all of you that have answered 3s, you are all participants in the market. Whether you are participants as an active participant because you're trading actively, or you're more passive because you put your money into an ETF or a mutual fund and you let someone else deal with that, regardless of how you do it, you are a participant in the market. Now, when we talk about options, we are also participants in the market, but we're participants in the markets typically in a different way. Number one, most options traders are looking to utilize leverage in their portfolio. Now, leverage many times for a lot of investors is a double-edged sword, because leverage can work in your favor if you get the direction of the market correct, but can really hurt your portfolio if you get the direction wrong. But options provide a very unique instrument in the ability to provide you with leverage if you are correct on the trade, but do so in a way with limited risk, so that if you're wrong on that trade, there's a limit as to how much money you can risk. And you can choose different options to choose how much risk you want to take. This is something that's truly unique to trading options, is to be able to get that leverage if you're right, but only risk a set amount if you're wrong. This asymmetrical risk is what actually attracts a lot of beginners to trading options. Is they say to themselves, yes, I want to get paid a large sum of money if I'm right, but only lose a set amount of money if I'm wrong. So this is what I tend to find attracts a lot of investors to first look at options in the beginning. But when we actually take a look at what do people actually trade, what strategies do options traders actually deploy in their portfolio, the most popular strategy is actually income generation. So this is actually predominantly stock or ETF investors. So just like everyone here that answered 3, and you may have a desire to leverage your capital and speculate on the direction of the market. But most of you are passive investors. You are longer term investors. And what options can provide you with is an opportunity to actually generate more income off of your current stock and ETF investments. Think about all the stocks you hold in your portfolio. Those are assets that you own, and you can leverage those assets to generate income. The same way that those assets can pay you a dividend yield, you can sell option strategies against the stock positions to generate an additional yield. So by far, the most popular strategy from options traders is actually not speculating with limited risk. It's actually income generation. So that's actually what is traded the most. And then lastly, what is probably one of the things that I think is most interesting for those of you that are fairly creative, or especially for those of you that are very active in the markets, is to really create customized payoffs. What do I mean by that? So when you trade stocks, there are only two payoffs that you can get. Either the stock goes higher and you make money, or the stock goes lower and you lose money. Those are the only two payoffs. It doesn't matter whether the stock makes the big move in 1 day or 1 week or 1 year, you get paid the same amount if the stock goes up by the same amount. But when you're trading options, you have a lot more flexibility. You can choose whether you think the stock's going to go up or down. You can make money if the stock goes sideways. You can make money if you think the stock's going to go up 1 month and then down the second month and then up the third month. You can really create fully customized payoffs, and you can get exposure not just to the direction of the stock. You can get exposure to time. You can get exposure to volatility. There are lots of things that you can get exposure to, not just the price movement of the stocks. And that's really where the creative side of options comes into play. And that's why it's so important to understand the fundamentals, because in order for you to create these types of customized payoffs, you must first understand the fundamentals of options before you can even start structuring these types of custom payoffs. So that's why I want to spend the time to make sure that everyone here understands those fundamentals before you can move on and start learning these strategies and learning how you can deploy them for your portfolio. But the thing is really the flexibility that options provide you with, because again, when you're trading stocks, there's only two exposures that you can get access to: the stock going higher and the stock going lower. That's it. When you're trading options, you can get exposure to a whole lot. And lastly, mitigating risk. Arguably, every single option strategy that I've talked about here before is all about actually mitigating risk, because there's plenty of ways that you can get leverage. You can get leverage from your brokerage account, but leverage also means that you're exposing yourself to additional risk. So with options, everything is to reduce risk, right? So when we talk about speculating, we're talking about limiting risk. When we talk about generating income, what that effectively does is limit the risk of your equity investments, or lowers the risk of your equity investments. Creating customized payoffs is also designed to provide limited risk, but mitigating risk across your entire portfolio is to protect your portfolio and the profits that you may have made. So unrealized gains that you might have on a portfolio, that you want to lock in those unrealized gains from a market sell-off like we had in February and March. Options provide you with another additional tool that can provide you with protection to the downside. Those are the primary use cases of why an investor typically utilizes options. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Okay, perfect. I see a lot of 4s. So let's talk a little bit about income generation, because like I said, despite the fact that most investors are interested in options because the leverage and the speculation aspect of it, when we actually look at transactional volume, the most popular strategy is generating income. So most of you, we don't think of options and stocks as really that related, but the most popular strategy is actually for your stock positions. So think about your stock positions. Forget about options trading for 1 second, because a lot of investors feel, especially in the beginning, that options are very complicated. Forget that for 1 second. Think about your stock position. Think about maybe think about like H&M stock that you might hold in your portfolio. So when you hold that stock, what happens? There's 2 things that happens. The stock can either go up or down, and you can make money or lose money from that. And then you get paid dividends as you hold on to that stock if it's a dividend paying stock. Now, what you can do with options is you can actually purchase H&M stock when you're ready to buy the stock at a discount. And then while you hold on to the stock, while you wait for that stock to appreciate in value, we can collect income every single month from owning that stock. So as long as you own that stock, let's say you own that stock for 12 months or 24 months or however long, or maybe even just 2 months, however long you choose to own that stock for, you can generate an income stream from the assets that you own in your portfolio. So this is really where we look at selling cover calls, which is the first beginner strategy. So some of you that answered 2 in the very beginning, meaning you've traded options before, this is probably the strategy that you're most familiar with or that you've executed the most. But the one that's actually most underutilized by most equity investors is selling a cash secured put. It's an overlooked strategy because the risk on the strategy looks like it's really high. And a lot of people will say, I don't want that risky strategy. But what they're not looking at is the risk of selling a put versus buying a stock. because those are the two strategies that you should be comparing it. And when you compare selling a put versus buying a stock, selling a put is actually less risky than buying the stock itself. So it really allows you to buy the stock at a discount. And this is, in my opinion, as a market strategist doing this for the last 15 years, the most underutilized option strategy for an equity investor. Think about all the stocks that you have purchased in the history of your account. Imagine if you can get maybe a 1 to 2% discount on those stock purchases, or even a half of those stock purchases. How would that perform for your portfolio? It's not going to change your portfolio from night to day, but it will add some additional yield to your portfolio if you're able to pick up half of your stocks for a 1 to 2% discount. That's exactly what a cash secured put allows you to do. It has nothing to do with trading options, has nothing to do with speculating, it has to do with your stock investments. And lastly, once you get familiar with selling covered calls and cash secured puts, then we can start getting into a little bit more advanced strategies, selling credit spreads. You can actually collect income on stocks that you like when you have either a slightly bullish or slightly bearish view on that stock, and just collect income based on that directional view. You don't have to own the stock. You don't have to want to own the stock. You can just collect income. So those are the three different ways that many equity investors start to utilize options to help them generate an income stream. And like I said, when you look at the balance of all the volume that's actually traded, these three strategies combined make up at least 50% of the volume of traders here in the market. So very powerful tool in helping you generate income for your portfolio. Now, like I said, what attracts many investors to options is the ability to trade with leverage, but do so with limited risk. Everyone wants that risk, the reward part to work in their favor. No one wants the risk, right? Everyone wants some of the magic bullet as to how to, get as much capital as possible if you're right, and then risk the smallest amount as possible if you're wrong. Well, options provide you with that opportunity, but it's not some magic bullet that will just erase any losses from your portfolio or limit the amount of risk for your portfolio. There are some trade-offs that you have to make in order to get that asymmetrical risk. But what it does allow you to do is control 100 shares of stock for each option contract for just a fraction of the capital that would normally cost you to buy 100 shares of that contract. And all of these contracts are limited risk strategies, meaning before you enter that contract, you know what is the maximum amount that you can lose. So no matter what happens, even if the stock goes to zero or the stock goes to infinity, you will only lose that amount that's set when you enter the contract. So that's a limited risk side. And on some of the strategies, you have unlimited upside. So if you do get the direction correct and the stock makes a big move, there's no limit as to how much money you can make while you have a limited risk to the downside. So the strategies that you would be looking at as a beginner is just buying a call and buying a put option. Those are the two strategies we're going to explore here today. These are the beginner strategies. As you get a little bit more advanced, then we can start taking a look at debit vertical spreads. For those of you that have followed our education, this is something that we cover in our intermediate courses. And then the vertical credit spreads. Those are the ones that I talked about in the income generation strategies, but they also fall under this category of leverage with limited risk. So that's your progression as a trader, is you start with buying calls or puts. That's your simple option strategy. And then what you learn is that the trade-offs that you make for this asymmetrical risk sometimes can actually be quite expensive. So what you try to do is you find ways or creative ways to use options to reduce your risk even further, reduce the trade-off or make the trade-off work in your favor. And that's really where we start getting into some of the more advanced strategies, buying debit spreads, selling credit spreads. But that's how you progress as a trader. And lastly, hedging against market corrections. So this is the part that is least used because markets don't fall very often. They don't have these big crashes very often. Many times you can go years without a significant market crash. Arguably, we haven't had one in over 10 plus years, and we just had our first major market crash. But this is really where it's a tool that you have in your toolbox. You don't use it very often, but when you need it, it'll be very, very useful. Basically, what a put option can do, it can protect your portfolio against a market downturn, and it can protect your profits on an equity investment. Maybe you have some stocks that you invested 10 years ago where you have a large unrealized gain but you want to keep holding on to that stock because you think that stock long-term is going to continue to outperform, or you still think that that stock is going to have more upside. But you're concerned that a short-term correction like the coronavirus could potentially impact your portfolio. So you want to lock in some of those gains. So a beginner strategy would be buying a put option. And then as a more advanced strategy, you might buy a put spread. Now, these are option strategies that you can utilize. I will say that from a portfolio protection perspective, there are better ways to protect your portfolio than buying a put option. But for some investors, put options are the best use for your portfolio. There are other products that you can also hedge your portfolio with, such as futures. And those are some of the things that we also provide some education around if you want to use futures to protect your portfolio. So as part of this partnership that we have with NASDAQ, we're really hoping to help give everyone a better understanding as to how derivatives can be used in your portfolio to limit your risk. So when you limit your risk, what happens is you're able to amplify your returns. When you limit your risk, you're able to prevent account blowups. And this is really what we're here to teach, is to show you how you can utilize options in these particular manners to limit the risk in your portfolio. Does that make sense, everyone? Please type 5 into the chat window if this makes sense to you. Perfect. Okay, I see a lot of 5s. So now let's talk a little bit about an option contract. What is an option contract? So remember, an option is a contract between two parties. So just like a legal document or a contract that you might enter when you're going to a business, or you sign a contract for a new cell phone, whatever that is, it's a contract, a legal agreement between two parties. That's exactly what a contract is. And this is the part that I hate the most about teaching options, because this is where I have to read some legal language to you. And the first time you read this legal language, you're going to say to yourself, that does not make a lot of sense to me. I'm going to need you to clarify that to me. And that's okay if you don't understand it the first time. When I first read this for the first time, I had no idea what this meant. But an option contract provides the buyer of the option the right to, but not the obligation to, and it's a mouthful here, and I'll explain it to you in 1 second. An option contract provides the buyer of the option the right, but not the obligation, to buy in the case of a call option, or sell in the case of a put option of an underlying stock or ETF at a specific price on or before an expiration date. So let's just break that down again. So for each contract, there are two sides. You have a buyer and you have a seller. So whenever you have the buyer of a contract, it gives the buyer the right, but it doesn't obligate them to. The buyer has the option to either buy the stock if they're buying a call option, or sell the stock if it's a put option of a specified stock or ETF. And there is a specified price at which they can buy the stock at, and they can exercise this right. They can leverage this right anytime on or before the expiration date. So like I said, that's a mouthful, and it takes a bit of time to really grasp that if you're brand new to option contracts. And that's confusing anyone. Please type yes into the chat window if you're a little confused by this statement, because it is confusing. So I think the best way to really understand this is to go through some examples. But the main thing to remember is the fact that there's two sides. There's a buyer and a seller. And to enter the contract, the buyer has to pay the seller for this option, because the buyer is the person that has the option to do something. So in order for them to have that option, they need to pay the seller for that. That's the most important thing to remember. And what option is the buyer buying? In a call option, they have the right to buy. In a put option, they have the right to sell. So you're basically saying that I want to buy the option to buy the stock from you at a specific price, either anytime between now and the expiration date of that contract. And I, as the buyer, have the sole right to exercise that option, or I can also say, I'm going to walk away from this, and the only thing you lose is what you pay for that option. So that's where we're going to try to spend a little bit of time in breaking down and help you better understand this contract. So like I said, you have a buyer of a call, you have a buyer of a put, and then on the other flip side, you have the same person who sold the call to the person and the person who sold the put to the person. So you have a buyer of a call, buyer of a put, seller of a call, and seller of a put. Those are the 4 basic contracts that you can enter as an options trader. So what we want to do is we want to break down these 4 contracts so that you have a better understanding as to what they actually mean. So, one of the ways to think about this is think about when you might want to buy a call, buy a put, when you might want to sell a call, when you might want to sell a put. So one of the easier ways to remember this is if you assign a positive sign to buy and a call option, and a negative sign to sell and a put option. What you can do is you can do some basic multiplication and give you a better understanding as to what's a bullish strategy, what's a bearish strategy. So for example, if we're looking to buy a call option, buying a call is a positive and a positive. That's how we get that buying a call is a bullish strategy. If we're looking at buying a put option, this is where we're buying a put, which is a positive and a negative. That's how we get that buying a put is a bearish strategy. Now, if we're selling a call option as a seller of a call option, that's a negative and a positive. That's how selling a call option is bearish. And then lastly, if we're selling a put option, that's a negative and a negative. That's how we know that selling a put is bullish. So that's just a quick way for beginners to remember there's 4 strategies. How do I know which strategy is which? You can do some basic multiplication to help you remember buying a call is bullish, buying a put is bearish, selling a call is bearish, selling a put is bullish, okay? Now, I know this is confusing, but does that make sense, everyone, that positive and negative sign thing? Please type 6 into the chat window if that makes sense to you as just a trick to help you remember, what strategy is what. Okay, perfect. So, quick explanation before we run into a real example here. So, when the person buys a call option, the buyer is effectively paying the seller the option to buy, the right to buy a stock or ETF. So let's say this stock is H&M. So the buyer of this call option is saying that I want the right to buy H&M on a specific date or the expiration date. So let's just say, for example, this expiration date is November 20th. So basically he's saying that anytime between now and November 20th, I want the option to buy H&M from the seller at a specific price. So I don't know what H&M is trading at right now, but let's say that I want to be able to buy the stock from the user at 140 crowns. So the seller of that call option will say, okay, if you want the option to buy H&M stock from me at 140 crowns anytime between now and November 20th, you're going to have to pay me for it. Right? Let's say he says, well, you're going to have to pay me 7 crowns for that option. That means that this person the buyer has to pay the seller 7 crowns. And that's the most he can lose, because if between now and November 20th, the buyer doesn't want to exercise his call option, that call expires worthless and he loses his $7. The person who sold the call option keeps the $7. And I think the best way to remember this is to go through a real example to show you. But that just gives you a real example of what it means to buy a call option, okay? So let's go through an example here. Let's say I want to buy a 100 crown call option. And let's say that call option cost me 4 crowns to enter this contract. So what I want to do is I want to show you why someone would ever want to buy a 100 crown call option and pay 4 crowns for that option, okay? So I know there's a lot of investors here or a lot of attendees here who have some experience trading options. So I'm gonna rely on a few of you to help me answer some questions. So remember this, as a buyer of this option, it gives me the right to purchase the stock at 100 crowns anytime between now and expiration, and I paid 4 crowns for that option. So let's say the buyer buys this option because he's bullish on the stock, and on expiration date. So let's just put this for now that this is a November expiration date. Okay, so let's say this is November 20th. I don't even know if that's a weekday or not, but let's just say the expiration date here is November 20th. And so I buy this call option, I pay 4 crowns for it. And on November 20th, let's say the stock that I purchased this option on is trading at exactly $100. So how much is this option worth to me if on the expiration date, the stock is worth $100? So I have the right to buy the stock at $100, but the stock itself is trading at $100. What is that option worth to me? If anyone has the answer, please type it into the chat window. How much is the option worth to me if I can buy the stock at $100 and it's trading at $100 on the open market? Michael is correct. The answer is 0. This option is worthless to me. But remember, I paid $4 to get into this contract. So guess what? If I buy this call option and the stock stays at $100, meaning it doesn't move, how much money do I make at the end of this contract on November 20th? The answer is I lose 4 crowns because the contract is worthless to me, but I paid $4 to get into it. So my call option is worth effectively negative 4 crowns because I paid 4 crowns to get into that contract. Does that make sense, everyone? Please type 7 into the chat window if that makes sense to you. Now, for any price below $100, this is going to be true also, because guess what? Why would I want to buy the stock at $100 if, let's say, the stock on expiration date is trading at, let's say on expiration date the stock is at 95, right? So I have the option to buy it from the buyer for from the seller for $100, but I can buy the stock on the open market for 95. Why would I ever want to exercise my call option to buy the stock at $100 when I can buy it on the open market for $95? The answer is you wouldn't. So that's why, if let's say the stock is at $95, I also lose $4. And what you're going to see is that for any price under $100, it doesn't make sense for me to exercise this call option because I can buy the stock for a cheaper price on the open market. It doesn't make sense for me to exercise my call. So what you see is that when you buy a call option and the stock is at any price below the strike price, this is a call option that's worthless to me. So guess what? I lose the $4 that I pay. That's the limited risk part that I'm referring to with option contracts, is that when you buy a call contract, no matter what you pay, that's the most you can lose. You cannot lose more than that. Even if the stock goes to 0, the most you lose is the $4 you pay for that option. Okay? If that makes sense, everyone, I just want to make sure that makes sense, everyone. Okay? So now, let's say on the flip side, on November 20th, the stock is trading at a little higher. Let's say the stock is trading at 104. Let's say the stock's trading at 104 on November 20th. How much is this call option worth to me if the stock is trading at 104? If anyone has the answer, please type it into the chat window as well. If the stock is at 104 and so the answer is that it's worth $4 because I have the option to buy the stock at $100, but the stock's trading at 104. So guess what? It makes sense for me to exercise my call option. So as the buyer of this call option, I'm going to exercise my right. I'm going to say, I'm going to buy the stock from you, the seller, for $100 because guess what? Once I buy it from the seller for $100, I can immediately sell it on the open market for $104 because that's where the price of the option is on expiration. So guess what? If I exercise my option, I immediately take in a $4 profit. I can exercise it, but buy it for $100 and immediately sell it for 104. But remember, I paid $4 to get into the contract. So guess what? The $4 profit that I made when the stock goes up to 104 is completely offset by the $4 that I paid to get into the contract. So at 104, the contract is actually worth $4, but because I paid $4 to get into it, my P&L on this trade is actually 0. Does that make sense, everyone? Please type 8 into the chat window if that makes sense to you. That when the stock moves higher, I made money on the option, but because I paid $4 to get into the option, that offsets my gains, right? So if the stock goes to 104, I make no money on this trade. I also don't lose any money, but I don't make any money. Now, let's say on the expiration date, the stock's higher. Let's say it's at 107, right? Let's say it's at 107. So now, does it make sense for me to exercise my call option? Absolutely, because I can exercise it, buy this stock for $100 and immediately sell it on the open market for $107. That realizes what? A $7 profit for me. And remember, because I paid $4 to get into the trade, what that means is that I make roughly 3 crowns on that particular trade. So here I've lost 4 crowns, here I've made 0 crowns, here I made 3 crowns. And guess what? For the more the stock goes higher, the more money I make because I only paid $4 to get into the contract, right? So if let's say the stock's at 110, then I'm going to make the $10 profit minus the $4 that I receive. So I can make $6 if the stock's at 110. And what you start to see is that you get a line that looks like this. So if the stock goes higher and higher and higher, guess what? I can make more and more money. That's how this is the asymmetrical risk that I was referring to. So when do you want to buy a call option? You want to buy a call option if you think the stock is going to make a big move to the upside, and you're concerned perhaps that there is a possibility that the stock may make a move to the downside. Because if the stock does make a move to the downside, a call option protects you. You cannot lose more than the $4, but you can make a lot of money to the upside. So this is the asymmetrical risk that I'm referring to that attracts a lot of investors to trading options. Now, what is the trade-off with this asymmetrical risk? The trade-off is the fact that even if you get the direction right? You think the stock's going to go higher, but the stock can't just go higher. It has to go higher by a certain amount, because if the stock goes higher to 104, you're just breaking even. You're not even making money at that point. You have to believe the stock will go to 105, 106, 107 before it's worth your while to buy that call option. So to call this bullish, in my opinion, is not 100% correct. You have to be fairly bullish. You have to think that the stock's going to go from 100 to 107, 108, 109 before it makes sense for you to buy that call option. So that's the trade-off that you make when you're seeking this asymmetrical risk. You're effectively trading off some downside risk in exchange for the stock requiring the stock to make a fairly sizable move to the upside before it makes sense for you to buy the call option. So you don't want to just buy calls when you think the stock's bullish. You have to think about how far do you think the stock's going to go. You have to also account for how much do you have to pay to get into the call contract. Sometimes this call might not be $4. Maybe it's $6. I'm sorry, 6 crowns, right? If it's 6 crowns, then the stock needs to go all the way up to 106 before you start to break even. So the cost of that call option is another element that you need to account for when you're thinking about buying that call option. Does that make sense, everyone? Please type 9 into the chat window if this makes sense to you. Perfect. Okay, I see a lot of 9s. This is the most challenging part, I think, for most beginners, because you're thinking to yourself, okay, call options are bullish. Let me buy a call option because I think the stock's going to go higher. The stock does go higher, but maybe not enough, right? So sometimes you buy a call option, the stock goes from 100 to 102. And you say to yourself, okay, I was right on the direction. And next thing you know, you realize that you've lost some money. And this is where beginners who didn't take the time to learn don't really understand why they lost the money. They don't realize that the $4 that they pay, you need to overcome that first before you can make money on that call option. So it's really important to understand that the cost of the call option is a very important factor to determine whether or not it makes sense to buy that call option, because the more you pay for that call option, the more the stock needs to move before you can make a profit. So the cheaper the call option, the less the stock needs to move before you can make a profit. Does that make sense? Okay, so now let's talk about put options. Let's talk about buying a put option. So now we're talking about the right to sell a stock at a specific price. So let's say we buy a 100 crown put option, and let's say it now costs me $4. So this gives me the right to sell the stock at for $100 at any time between now and expiration. Let's say that expiration is November 20th. So let's work through this example. So let's say at expiration date, so I buy this call option, this put option, it cost me $4. And at expiration, the stock's still at $100. So I have the right to sell the stock for $100 that I can buy on the open market for $100. What's that option worth to me? The answer is that option's worth nothing. So I wouldn't exercise this put option. And guess what? Because I paid $4 to get into the contract, I basically lose my 4 crowns by the time the stock is at $100. Now, this is going to be true for any price the stock is above $100, because guess what? Why would I want to sell the stock to the seller for $100 if, let's say, the stock's now on the open market for 105? Let's say the stock on November is at 105. Why would I want it to sell it to you for 100 when I can sell it on the open market for 105? The answer is you wouldn't. That's why for any price above 105, or I'm sorry, above 100, what you lose is the $4 that you pay. So what you start to see is a mirror image graph of what you saw before. So when you buy a call option, you want the stock to go higher. You don't want the stock to go lower. When you buy a put option, it's just the exact opposite. So now let's say the stock does move lower. Let's say the stock moves down to $96. So I bought a put option and the stock went lower. It went down to 96. So now I have the right to sell the stock to the seller for 100 crowns when it's on the open market for 96 crowns. So guess what? I'm obviously going to want to sell it to the seller for 100 if instead of selling it to the open market for 96, I can receive 4 more crowns for selling it to the seller than selling it on the open market. So I'm going to take that trade. But because I paid 4 crowns to get into the trade, my break-even price here is 96 crowns. Basically at 96 crowns, I don't make any money and I don't lose any money because what I gained on the option is completely offset by what I lost on the put contract. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. And this is true for any price as you go lower and lower, because the lower the stock goes, the more I'm going to want to sell it for $100 as opposed to selling it on the open market for a lower price. So what happens is when you start to look at a put option, this is what the P&L chart of a put option starts to look like. And like I said, it's a mirror image of a call option, right? The call option looked like this before. Now you just have the mirror image of that, okay? So a put option is simply for when you have a bearish view on an underlying stock. This gives you the right to sell the stock at a lower price, but the trade-off that you're making here for this asymmetrical risk, so unlimited gains to the downside with only risking 4 crowns, the trade-off here is that you have to believe not just that you think the stock's going to go lower, you have to believe the stock is going to be below 96 crowns or more before it makes sense for you to buy that put option. So when you think about buying a put option next, not only do you have to ask yourself, am I bearish on this stock? You also have to ask yourself, well, how much does a put option cost? And do I think the stock's going to be below that amount by expiration? If the answer is yes, then you might want to buy the put option. If the answer is no, let's say you think the stock's just only going down to 98, guess what? Doesn't make sense to buy the put because you'll lose money if the stock goes down to $98 and you paid $4 for this put option. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Okay, I think for today, I've taught enough here. I've given you a lot of information to digest. Especially for those of you that are brand new to options trading, the biggest challenge with all of this is really understanding, how a contract works and when it makes sense to potentially buy a call contract, when it might make sense to buy a put contract, and what are the trade-offs that you're really making when you're buying a call or a put versus buying the stock versus selling the stock. And this is a part that's going to take investors who are brand new a bit of time to get used to, which is why we record these sessions, which is why we make the slides available to you so that you can follow along at your own pace. Like I said, if you're brand new to options trading, it's something that takes a bit of time. So I hope that this was useful in helping you give you a better understanding of option contracts. Next time, what we're going to talk about is the difference between buying versus selling options. Today, we talked about buying calls and buying puts. Next time, we're going to talk about the person on the other side of that transaction, the person who sold you those calls and puts, the person who collected those 4 crowns. What do they get? Why would someone want to sell a call? Why would someone want to sell a put? What are the benefits and risk involved in that? And once you understand buying calls, buying puts, selling calls and selling puts, then you really have the world to your, the world opens up in terms of options once you understand these 4 fundamental strategies. And Dimitri, on our next session where we talk about buying versus selling options, that's when I will talk about the Greeks. I will introduce the Greeks, because as of right now, we've only talked about the option contract, either when you enter the contract and what happens at expiration. But there's a lot of middle ground between now and expiration. What happens if the stock moves higher in 2 days? What happens if it moves higher in 7 days? There are a lot of things, and that's where we have to turn to the Greeks to give us a better understanding as to the value of your option between now and expiration. So that is something I'm going to be covering on our next session. So I hope that you guys will be able to join us for that. So with that, I want to thank everyone for taking the time out here this afternoon, or this evening rather. And again, just to reiterate, if you are brand new to options trading, if you're in the learning process and you don't have access to the tools, we have them all free of charge, courtesy of the NASDAQ Nordic Exchange. You can sign up for that tool at optionsplay.se. And at this point, what I'll do is I'll open this up for Q&A. If anyone has any questions regarding option strategies, the basics of buying calls, buying puts, perhaps if you want to ask some questions about any other options related questions, feel free to type them into the chat window, and I'll try to answer a few questions before I sign off here for today. But thank you so much for taking the time out here on your busy evenings. Michael is saying, what determines the price of an option? The market does. So think about what determines the price of a stock. Buyers and sellers in the market. You think about the bid and ask quotes that are out there, all the bids, meaning people who are willing to buy the stock, versus all the offers, the people who are willing to sell the stock, and the middle ground, the equilibrium between buyers and sellers. That's what determines the price of a stock. That's the same thing that determines the price of an option. You have buyers of calls and you have sellers of calls, and those two forces will basically offset each other until they can agree to a price. So buyers will have a bid price, sellers will have an offer price, and that's how we determine the price of every asset in the market. And Michael, just to expand on that while anyone else types in any questions, the biggest factor that determines the price of an option is really the volatility of the stock. The volatility of the stock, so the more volatile the stock is, the more expensive the call or put option will generally be. The less volatile the stock, the less expensive the option will be. There are other things to factor into, meaning how long between expiration. So if you're trading an option that expires in 1 week, it'll be obviously much more cheaper because you have a much smaller window to exercise your call or put option. If you're buying a 1-year option, that's going to be far more expensive because you have a lot more time to exercise those call options. And then lastly, the price at which the strike price, the price at which you want to buy the stock at, is also going to be a big factor in the price of your option. So those are the three biggest, I would say, inputs into an option price. When is the next course date? So it's exactly 2 weeks from today. We do it every Wednesday afternoon, right after the close, is the time for the course. So in 2 weeks' time, I believe it's September 30th, if I'm not mistaken, is the next course date. Roger's saying the difference between European and US options. So, you know, when we're looking at the options here in Europe, they're not actually European options. They're actually American style options. So to be perfectly honest, for most traders, there's no difference between European and American options because it almost never makes sense to exercise your call option early. So, you know, European options are options that you can only exercise at expiration. American options are options that you can exercise at any time between now and expiration. So when we talk about stock options that you're trading here in the Nordics, those are American style options, meaning you can exercise them at any time. But from a trading perspective, it never makes sense to exercise early. So for all intensive purposes, American options really are European options. The pricing of them are almost identical, unless there's a big dividend being paid. That's the only time when you do have some slight differences between American and European options. Why are there options for some stocks and not for others on the same market? It really comes down to how liquid the underlying stock is or how actively traded the underlying stock is. Usually there are minimum requirements in terms of number of shares that needs to be traded for the underlying stock before an exchange will list an option on it. So basically, the more popular a stock is, the more likely that an option will be listed. The less popular the stock is, the less likely there will be options listed on them. But it really just comes down to market cap for the most part, because they're mostly concerned about liquidity. They don't want to list an option where the stock's not very liquid, and market makers aren't going to make a market that traders will want to trade on. So they try to select the number of stocks that are available for options trading only in the stocks that have a lot of interest and have a lot of volume. Any other questions? There are standardized and non-standardized options. Are the latter more risky? No. So standardized options and non-standardized options only come as a result of a corporate action. Meaning, let's say you own H&M stock and H&M has a stock split. Let's say they split 2 for 1. So what happens is originally you might have had one call contract for 140 crowns, but now because the stock split in half and now it's trading at 70 crowns, you would effectively own 2 non-standard contracts that have a strike price of 70 crowns as opposed to one contract at 140 crowns. So it's just the adjustment that causes those non-standard options. From an options trading perspective, they are identical. They are exactly the same. There's no less or more risk in a non-standard option. There's a couple of questions about useful books to read. So I can suggest one book here. Let's see. Understanding. I can recommend this book, which is a simple book, I think, for a lot of you that are relatively new to options trading to be able to, oops. I will post a link into the chat window. It's a good book, I think, for most beginners to start with. And there is both the Kindle and the paperback version if you're looking for either one. So I hope that answered your question. Can you recommend a platform that allows for paper trading of options to get used to the mechanics as for trading stocks, if any exist? So Tobias, as far as I know, there's only one platform that offers Nordic country clients or accepts clients from the Nordic countries that has a paper trading account, and that's Interactive Brokers. Is it possible to trade options on exchanges on other continents? Yes or no? So Michael, the ability for you to trade options on other exchanges purely comes down to your brokerage firm, whether your brokerage firm allows it or not. So one of the, Interactive Brokers does offer global exchanges. You can trade pretty much on I think almost like 180 different exchanges around the world. And that is one of the benefits of Interactive Brokers, is that it's cheap to trade. The commissions are really low. They offer paper trading and they have access to global exchanges. There are account minimums to open those accounts. But Interactive Brokers is one of the few brokerage firms that accepts global clients and allows you to trade on all these global exchanges. Can you recommend some good trading platforms for trading options? So I think that's the same question. Certainly Interactive Brokers is one that I can speak to. Any other questions? If there are no other questions, I just want to thank everyone for taking the time out here this evening. I really hope that this was useful in helping you better understand option contracts, specifically buying calls or puts. Even if you're an experienced options trader, I think it's an important lesson to remember that when you're buying a call or a put, there are some benefits to it, but the trade-offs are the fact that you have to pay for that call or a put, and you have to factor that into your decision as to whether it makes sense for you to buy that call or a put, because you have to overcome that amount for the stock to move that amount before you can be profitable on that call or put. And it's a very, very important lesson for anyone who's trading options. So thank you so much. I hope that you guys all have a great evening. I will send out the recording with the slides after we finish here today. And if you have any questions, please email us. And we're looking forward to continuing your options education here with us. Thank you so much and have a great evening.